The biggest risk in a banking crisis is not what people think. It is not just loss, it's being trapped. Your money is in the account, but you cannot move it when you need it most. And that is exactly why this matters right now, because we have already seen several banks fail, and most people still do not understand how exposed they actually are. So watch this closely if you are worried about the banking system and if it will hold up or not.
There's a restaurant owner in Chicago right now who doesn't know he has a problem. His name doesn't matter, his situation does. He has $300,000 sitting in his business checking account. Payroll, suppliers, rent, everything his business runs on. $250,000 of that is protected. The other $50,000 isn't, and he has no idea. Most people don't. And here's why I'm telling you this. Because what happened on January 30th changed his math entirely, and possibly yours. By the end of this video, I'm going to show you exactly how to read the warning signs before this becomes your problem. Keep watching, because this is not about one bank in Chicago. This is about yours. On January 30th, 2026, Illinois regulators shut down Metropolitan Capital Bank and Trust, River North, a Friday night. 3 words in the filing: unsafe and unsound. No press conference, no warning to customers, no notice on the website. By Saturday morning, every deposit had been transferred to a Detroit bank. Clean, efficient, over. For people with less than $250,000 in their account, they woke up Saturday and their money was there. Different bank, same balance. But here's the question no one asked. What about the people who had more? That's where it gets real. That's the part the headlines skipped. Let me take you back to March of 2023, because this is where the modern blueprint for what you need to fear actually lives. Silicon Valley Bank, one of the top 20 banks in America at the time, $209 billion in assets, 16 years old. On a Wednesday, everything was normal. People showed up for work. Loans were being processed. On Thursday morning, the bank disclosed they needed to raise a little capital. Routine on paper, nothing that should have caused panic. But Peter Thiel's Founders Fund sent a message to its portfolio companies that Thursday afternoon. Get your money out now. And that message spread through group chats, Slack channels, founders texting founders, VCs texting VCs. By Thursday night, companies were pulling tens of millions of dollars per hour. Not thousands, tens of millions. The Federal Reserve later calculated that $42 billion fled in a single day. By Friday afternoon, a regulator shut it down. 48 hours from a routine filing to complete collapse. Now let me tell you what that actually looked like for real people. Roku, the streaming company, had $487 million sitting at Silicon Valley Bank. All of it uninsured above the limit. They had to disclose it as a material financial risk. Dozens of startups had their entire payroll accounts at SVB. Every dollar they used to pay people, sitting in a bank that no longer existed. One founder posted publicly that she had 11 employees and 2 weeks of operating cash, and every cent of it was locked. Her employees had no idea. They showed up Monday expecting a paycheck. That is what a bank failure actually looks like. 11 people, Monday morning, no paycheck. Now, I know what you're about to say. The government stepped in. They made everyone whole. It was a one-time thing. That's partly true. They did cover the uninsured depositors that time. But they made one thing very clear afterward. They are not legally required to do that again. The law says $250,000 per account. That is the guarantee. Everything above that is not. And here is the number that should stop you for a second. 1/3 of all deposits in American banks right now are uninsured. That's not a theory. The FDIC published it. So the real question isn't whether bank failures happen. One already happened this year. The question is, what actually happens to you when yours does?
Hey, real quick, sorry to cut in, but if you're watching this and you're realizing how quickly financial stress can move from headlines to personal problems, that is exactly why you need a real plan before the next downturn hits. If you want to understand how to position yourself for what comes next in real estate, instead of getting caught flat-footed, I put together a crash-resistant bundle that walks you through the cycle, where the risks build, and how to respond in each phase. Links down below. And now let's get right back into it.
Here's the scenario. It's a Friday. Maybe you've heard something, maybe you haven't. Regulators move on a Friday evening deliberately to give the weekend to sort out the resolution before markets open Monday. If you're under the limit, you're probably fine. Different bank, same money, weekend inconvenience. But if you're a business owner, a landlord, a contractor holding a down payment, anyone sitting above that 250,000 line, your account could be frozen while the FDIC works out who gets what. Payroll doesn't run, mortgage payment bounces, suppliers don't get paid, and it starts a domino that has nothing to do with how good your business is. Your bank made bad decisions. You paid the price. The restaurant owner I mentioned at the start, that 50,000 above the limit, that's the difference between making next month's rent or losing everything he built. He probably doesn't even know that business accounts and personal accounts are treated differently under FDIC rules. Most people don't. Okay, here's what I promised you. How do you actually read the warning signs before this becomes your Friday night? And before I get to that, I want to be clear. This is not financial advice. I'm not your bank regulator, not your financial advisor. I'm someone who spent weeks reading FDIC filings and balance sheets so I could explain what I found in plain language. First thing to look at, commercial real estate exposure. Banks that lent heavily into office buildings, retail spaces, apartment complexes, those are the ones under pressure right now. Why? Because $1 trillion in commercial real estate loans are coming due this year. Landlords who need to refinance are doing it at rates 3 to 5 times higher than when they originally borrowed. When landlords can't refinance, they default. When they default, the bank absorbs the loss. When the bank absorbs enough, you get a Friday night letter. Second, unrealized losses. This one is hidden and it's big. $337 billion in losses are sitting on bank balance sheets right now that haven't been formally reported. Banks bought bonds when rates were low. Rates went up. Those bonds lost value. Banks are holding them and waiting. That's the official FDIC number. Third, the capital cushion. When it gets thin, regulators move in. That's exactly what happened to Metropolitan Capital Bank in January. Now, the people who came out of the SVB collapse untouched had one thing in common. They understood the $250,000 rule. Some spread accounts across multiple institutions. Some held cash in Treasury money market funds, not because they predicted the collapse, because they knew the rules. I'm not telling you to panic. I'm telling you to know what game you're playing before someone else changes the rules on you. Here's what the landscape actually looks like right now. Dime Community Bank, commercial real estate exposure at 602% of their total equity. Flagstar Bank, over 500%. New York Community Bancorp, already downgraded to junk by Moody's. These are real institutions, real names. The warning signs were there before SVB. Most people weren't looking for them. The people who were, moved first. If this video helped you see something the headlines glossed over, leave a comment below. Share it with someone who needs to hear this. Not to scare them, to put them one step ahead. Because the question isn't whether another bank fails this year. One already did. The question is, do you know where your money sits when yours does?